It's 1970. A quiet mining town in northern Ontario, snow piled high, pickup trucks coated in salt, beneath the frozen ground, billions of dollars in nickel. Fast forward 50 years, glassed hours in Toronto, a housing market that looks like Manhattan on steroids, a banking system that didn't collapse in 2008, a country of just 40 million people sitting comfortably among the world's richest nations. Canada doesn't look loud, it doesn't look aggressive, it doesn't look like an empire, and yet its GDP per person is higher than most of Europe. Its banks are global giants, its citizens own some of the most expensive real estate on earth. So how did this cold, sparsely populated country get so rich? And more importantly, how solid is that wealth? Because the answer isn't just maple syrup and good manners. It's geography, it's commodities, it's immigration, it's housing, and it's a quiet financial machine most people never notice. And right now, that machine is under pressure. This matters because Canada is often presented as the safe version of America, stable, sensible. Boring in a good way, investors love it. Immigrants move there in record numbers, global capital flows in, but when you peel back the layers, the story gets more complicated. Let's start at the beginning. Canada didn't become rich because of tech startups or financial wizardry. It became rich because it won the geological lottery: oil in Alberta, natural gas, timber in British Columbia, wheat across the prairies, potash in Saskatchewan, iron ore in Quebec, gold, copper, nickel. If you printed a map of Canada's underground wealth, it would look like a cheat code. In the 20th century, especially after World War II, this mattered enormously. The world needed energy, it needed steel, it needed food. Canada had all three. While Europe rebuilt from ruins, Canada exported resources. While America expanded suburbs, Canada supplied materials. While Asia industrialized, Canada shipped raw inputs. Natural resources don't just create jobs. They create trade surpluses. They strengthen currency. They attract foreign investment. By the early 2000s, when China's growth exploded, commodity prices soared. Oil surged above $100 a barrel. Metals boomed. Canada's dollar rose so high it briefly matched the US dollar 1-to-1. For a moment it felt unstoppable. But commodities alone don't explain modern Canadian wealth. Plenty of countries have oil and minerals. Not all of them end up rich and stable. The difference was the system built around those resources. Canada developed one of the most tightly regulated banking systems in the world. Just a handful of big banks dominate the country. They're heavily supervised, conservative by design, boring on purpose. When 2008 hit and US banks imploded, Canadian banks didn't collapse. No dramatic failures, no Lehman moment to outsiders. This looked like brilliance. And in many ways, it was. Canada avoided the worst of the global financial crisis. But something else happened quietly in the background. Interest rates fell, and they stayed low. Low rates make borrowing cheap. Cheap borrowing changes behavior. Suddenly, mortgages became easier to afford. Investors searched for safe assets. Canada looked stable, safe, predictable. So money poured into housing. Toronto real estate started rising, then Vancouver, then almost everywhere. Between 2000 and the early 2020s, Canadian home prices more than tripled nationally. In some cities, they quadrupled. Wages did not. Here's where the system gets interesting. Canadian banks didn't just lend recklessly. They followed strict rules: mortgage stress tests, insurance requirements, conservative underwriting. So why did prices explode anyway? Because demand wasn't just domestic. Canada made a deliberate policy choice: open the doors. Immigration became a central pillar of economic strategy. Hundreds of thousands of newcomers per year, eventually over 1 million annually when including temporary residents and students. More people means more workers, more taxpayers, more consumers, more renters, more homebuyers, in a country with vast land but limited urban buildable space. Especially in cities constrained by geography and zoning, demand began to outrun supply. Think about Vancouver: ocean on one side, mountains on the other, strict zoning in between. Add global capital and rapid immigration. Prices climb. Housing became not just shelter, but the core asset of the middle class, retirement plan, investment vehicle, psychological anchor. By the 2010s, real estate and finance made up a huge share of Canada's GDP growth. Here's the irony: Canada avoided a banking crisis in 2008 partly because it was conservative, but over the next decade, the entire economy became increasingly tied to one asset class: housing. Household debt climbed above 100% of GDP, among the highest in the developed world, most of it mortgage debt. If housing keeps rising, this looks fine, even smart. If housing stalls, things get delicate. Now layer in another factor: government spending. Canada expanded social programs, healthcare, pensions, child benefits, infrastructure. During COVID, massive stimulus. Like most developed nations, debt rose sharply. None of this is unusual. The United States did the same. Europe too. But Canada's economy is smaller and more concentrated. When housing slows or oil prices fall, the impact is amplified. Oil matters more than Canadians like to admit. When oil prices crashed in 2014, Alberta went into recession. The national economy slowed, government revenues dipped. When oil booms, the currency strengthens. When oil falls, the dollar weakens. This is the classic commodity cycle. So Canada lives in two worlds at once: a modern, urban, service-based economy centered around Toronto and Vancouver, and a resource-based engine tied to global demand for energy and raw materials. When both are strong, Canada looks incredibly wealthy. When either weakens, cracks appear. Now we get to the uncomfortable math. Canada's GDP per capita is high, but productivity growth has lagged behind the United States for years. Business investment per worker is lower, output per hour is lower. In simple terms, Canadians work hard, but each worker, on average, produces less economic value than their American counterpart. That gap used to be smaller. It's widened over time. Why? Partly because capital flowed heavily into housing instead of business investment. When billions go into bidding up existing homes, that doesn't increase productivity. It increases prices, partly because large resource sectors can crowd out other industries. When oil is booming, talent and capital shift there, partly because regulatory complexity and smaller domestic markets make scaling global tech giants harder. Canada has world-class companies, but it hasn't produced an Apple or Amazon. Instead, it built a stable, asset-backed economy, and for years that was enough. Then inflation arrived, interest rates surged globally. The Bank of Canada raised rates aggressively. Mortgage costs jumped, housing sales slowed, prices dipped in many regions. Remember that household debt? Higher rates make it heavier. A family that stretched to buy a home at ultra-low rates suddenly faces renewal at much higher payments. Multiply that across millions of households. The banking system is still stable, but growth slows. Consumer spending tightens. Construction cools. At the same time, immigration remains high. Population growth has been one of the fastest in the developed world. That supports demand. It props up GDP growth. It prevents demographic decline. But it also strains infrastructure. Housing supply struggles to keep up, rents surge, so Canada's wealth today rests on a delicate balance. Resources feeding global markets, immigration fueling domestic demand, housing acting as a financial backbone, banks carefully managing risk. It's not fragile in the dramatic sense. There's no obvious collapse looming. This isn't a failed state story, but it is more complex than the postcard image suggests. Canada didn't get rich by accident. It leveraged geography, it maintained institutional stability, it avoided financial chaos, it welcomed people when others closed doors, it monetized land and credit in a disciplined way. That combination worked. The question is whether it scales, because long-term wealth isn't just about asset prices or resource exports. It's about productivity, innovation, output per worker. If housing remains the primary engine, growth may slow. If commodity prices fall for a decade, revenues shrink. If productivity doesn't improve, living standards drift relative to peers. And yet Canada still holds advantages most countries would envy: rule of law, political stability, massive natural resources in a world hungry for energy transition metals, proximity to the United States, a skilled immigrant workforce in a fragmented global economy, those assets matter. So, how did Canada get so rich? By selling what the world needed, by building cautious financial institutions, by turning land into leverage, by importing ambition from around the globe, quietly, methodically, without dramatic headlines. But wealth built on assets can feel permanent until the assumptions behind those assets change. If global energy demand shifts faster than expected, if housing affordability becomes a political breaking point, if productivity continues to lag, what happens then? Canada's story isn't one of reckless excess. It's one of careful accumulation. The snow-covered mining town still exists. So do the glass towers. The wealth is real. The question is whether the next 20 years look like the last 20, or whether the calm surface hides a more volatile future.